All right, today I am joined by my good friend Callum Newman. Welcome, buddy. Normally you're on a Wednesday, today you're on a Tuesday. Why the change? And why the smooth face,
Abs-
too?
yes, thank you very much. All to do with Brian's young boy, Sirius, who's starting school today, I believe, or kindy or something important.
Right. And by the way, the smooth face reference is due to Callum's weird camera that he's got going on today. He's ironed out all the wrinkles, but mine seems to be accentuated. Callum, today you're talking
Absolutely.
about iron ore. It's a bit of a follow-on piece from your last week's Factel Daily. But really, the story is about low expectations. Now, that doesn't sound too interesting when I say it like that, but over the weekend, we had some huge falls in the tech sector. I think we can start there. What's that got to do with iron ore and low expectations?
Well, I made the point last week with that iron ore could be, or iron ore stocks, I should say, could be a reasonable trade because, and part of the rationale for that was that they have such low expectations. That, as you say, that doesn't sound very exciting. But the reason I point that out is that when that's the case, you run much less of a risk of getting smashed on the day, which is what happened to investors in Nvidia and uranium stocks today on the ASX. Now, they're absolutely hammered. They're down around 15%. Nvidia copped a big whack as well. Now, I'm not saying those particular stories are over, but part of the reason been such a big reaction is that both those sectors, semiconductors and uranium, carried very high expectations and a lot of positive tailwinds that had been built into the price over the last year, even more. And that's the risk that you run when you go with that type of sector, is that if anything comes out and rattles the tin, like we've seen with the Chinese AI that's now been released, then you can get a big whack on the day. So again, if you're a long-term investor, it may iron itself out over time. We don't know. But shorter term or longer term, whatever you are, it's never nice to wake up to being 15% down, or in the case of the ASX, as the market opens. So part of the appeal when I made that piece around iron ore is that because everybody's written it off, basically, is that it's much less likely to happen.
Mm. You also mentioned a US fund manager today saying China is in a full-blown financial crisis, yet they've obviously released this new AI news over the weekend. Do you not agree with that view?
Well, not with his view. So that particular guy, Kyle Bass, is always he's been around forever. So as long as I've been at Fatal, he's been putting out big calls and that type of thing. And I just make the point that I don't remember him ever being right. He was right in 2000. He was one of those dudes who got famous in the housing crisis. And as far as I know, has been a bit of a one-hit wonder. I think he was talking about oil a few years ago. So he sort of swings. He's a macro kind of guy, and he's always trying to make a big call. But again, I allude to the iron ore price where you go, well, if China's in financial crisis, why is it still $100 a ton? Which, again, it has been around 100 to 130 over the last 3 years, which historically is actually quite a high price. Back in 2015, it went to 50 bucks a ton. So again, it doesn't really stack up. I made in the article the other week, I made the point that Chinese electricity production was up 6% last year. And there's an analyst called David Goldman, who I really like on China, and he points out that electricity production and GDP in China historically move at the same. So I think, again, it points to the idea that China is stronger than people think. And that's why I alluded to, potentially in iron ore trades. Interestingly enough, I write in today's article that it's a wonder that Fortescue haven't bought out a copper mine, and they're actually announcing an acquisition today, but it's an iron ore company, just a baby one. But again, they obviously see long-term demand holding up, or they wouldn't be buying more resources.
Well, why is it that every year we get a China scare story then? Why is that?
Well, yes, good point. So I've been here 13 years. Every year, I started with the Chinese ghost cities and all that stuff. Every year, somebody has to come out and say China's going to fall over. And thus far, every time they've been wrong, as far as I can remember. I'd say the US fund managers tend to get China wrong the most. Why that is, I don't know. But who was the short seller? Jim Chanos was the guy that was going to short them for years. He got burnt. Then Hugh Hendry had to go. He got taken to cleaners down in the Bahamas as a developer or something. So I guess they just want to make a name for themselves, and they want to get the big short. Everybody wants to be famous for getting the big call right. But historically, they're getting China wrong.
Mm. I've got a sort of a bit of a tangent question. Now, you talked about when you first arrived at FatTel, that it was all the China's ghost cities. That was when you started investigating the markets via the 18.6-year land cycle. What does that tell us going in? A pivotal year for that, by the way, is 2026. Can I just ask a bit of a side question on that? Like, although China nothing's happened, that all the predictions are wrong thus far, do you see anything changing in the next couple of years?
Well, absolutely, but not for the reasons most people point out. So the 18-year cycle that you're referring to is a US-led cycle. So,
right.
I mean, we talk about the Chinese ghost cities. Everybody had written off America back then as well. So it was supposed to be a low-growth, deflationary world for lots of different reasons. That didn't happen either. So the US stormed up, and they've sort of lifted the world with them all these last years, or last decade, I should say. So the problem that we'll face in not the next few years, but after that 2026 point, if you like, is that the US will be vulnerable, and when it's vulnerable, everybody's vulnerable, including China. So it's going to be interesting to watch. Got to be aware of it. But yeah, that's a US-led cycle. So China's influence on that is less clear.
Okay, fair enough. Back to the next question. Bringing back to iron ore, you say that the market is more likely to chase BHP and Rio rather than Fortescue. Why is that, Cal?
Well, the perception out there, rightly or wrongly, is that iron ore is now ex-growth. So that in the sense that China will pump out, X amount of steel, 1 billion tons of steel every year, but they're not going to need or want to do any more than that. And so therefore the demand for iron ore will plateau. So the investment markets always are hunting the next big growth story. Anyone who follows resources will know that every fund manager and his dog flogs the copper story, and it's probably true. And no, I believe it too. I shouldn't be so cynical. But so BHP and Rio both have copper portfolios, big ones, biggest in the world almost or certainly for BHP and Rio, and therefore the iron ore earnings are good as such. That's their most dominant earnings division, but the growth is going to come from likely to come from the copper price. So the market will more likely hedge by going into those two than Fortescue, which is a pure iron ore miner, really.
Okay. And final question, Cal, bit of a practical one. If you were to invest in one thing this week, what would it be?
One thing this week? Well, I can't give it away because I've just done my trade for this week already, so I don't want to give it away too much. But I'll say it's pretty tough out there. So for trading, it's hard to go long. There isn't a lot that's really running.
Even after the tech smash?
Yeah, well, what do you mean after the tech smash?
This weekend.
Yeah,
big falls in the NASDAQ.
Yeah, so that's not helping anybody by, putting a bunch of extra worries into the market. So generally, I went through my watch list this morning. Most things are red. So depends on your time frame. So you're either buying the dip for the long term, but if you're looking for short term stuff, there's not a heap available at the moment. But as I'm alluding to, so again, we're coming into the half year reports. The quarterly reports are coming out. So there's going to be our guides to what the market likes, what it doesn't like, and what it's not happy with. So, for example, Nuix, which is one of my recommendations, took a slug today too because even though it's up a country mile, the recent results are a little bit moderate compared to what the market had priced in. So you've got to tread carefully at the moment.
All comes down to expectations, doesn't it? As we're circling back to the start of the video.
That's the whole name of the game.
All right then, mate. We'll leave it there. Hope you found that useful. Do check out Callum's piece today. Links below. Check it out. Let us know what you think in the comments below. Cheers. Thank you, Cal.